While many retail investors are still asking, is it too late or will Bitcoin crash again? The real owners of the world are doing something very different. They are buying, quietly, strategically, and without headlines. Today, we're going to connect the dots between institutional data, ETF inflows, Bitcoin's risk metrics, macroeconomic signals from Japan, and the broader market structure to understand one key question. Are we already inside the early phase of the next crypto bull cycle? Let's start with what institutions are doing right now. 1. Institutions are positioning, not speculating. Coinbase has recently expanded its services, allowing institutions to borrow USDC using CBTH as collateral. This is not a retail feature. This is infrastructure built for long-term capital allocation. When institutions use Ethereum staking derivatives as collateral, it signals confidence not just in price, but in network sustainability and liquidity depth. This is important because institutions do not chase tops. They build positions during uncertainty. And uncertainty is exactly what retail investors are feeling right now. 2. Bitcoin Sharpe Ratio. A silent signal. One of the most overlooked indicators in crypto is the Sharpe ratio, which measures risk-adjusted returns. Currently, Bitcoin's Sharpe ratio has compressed. To many retail traders, this looks like weakness. But historically, low Sharpe ratio periods have occurred before major upside expansions, especially when volatility resets and long-term holders accumulate. In simple terms, less excitement, less noise, more preparation. This is how bull markets actually begin. Not with euphoria, but with boredom. 3. ETF inflows. The smart money tracker. Despite sideways price action, Bitcoin ETFs continue to attract capital. This is critical. ETF inflows represent regulated, long-only capital, not leverage-driven speculation. These flows are slow, steady, and extremely sticky. Every cycle has one common pattern. Retail enters late. Institutions enter early. Right now, ETF data suggests institutions are already inside the market, while retail is still waiting for confirmation. 4. Japan, yen pressure, and global liquidity. Now let's look at Japan. Japan's inflation data and the Bank of Japan's policy stance continue to pressure the yen. Historically, a weakening yen has pushed Japanese capital into alternative stores of value, including Bitcoin. At the same time, global liquidity conditions are slowly improving. This matters because Bitcoin is not just a crypto asset anymore, it is a global liquidity barometer. When fiat confidence weakens, Bitcoin demand rises quietly, not emotionally, strategically. 5. Market structure. Where are we in the cycle? Let's be clear. We are not in a full bull market yet. We are not in a bear market either. We are in the transition phase. Historically, this phase looks exactly like this. Bitcoin moves first, dominance remains strong, altcoins stay quiet, retail loses interest, smart money accumulates. Then, without warning, the narrative flips. By the time headlines turn bullish, most of the opportunity is already gone. 6. The real risk. Most people miss. The biggest risk right now is not buying the top. The biggest risk is missing the positioning phase. Because opportunities are never obvious when they matter most. They appear when fear is normalized, prices move sideways, and attention disappears. That's where we are now. Closing. The owners of the world are not asking whether Bitcoin will survive. They're asking how much exposure is enough. If you want the detailed breakdown, charts, and data behind this analysis, it's already prepared. Don't wait for the crowd. Because by the time everyone is talking about the bull market, the smart money is already taking profits.